Hello everyone, welcome back to our channel. And today we will be discussing about chapter 13 of SCCA Financial Reporting. This chapter discusses about IFRS 16 leases, where leases by itself is separated into two main parts, which is right of use asset and lease liability. What is a lease? So basically here are some elements of lease that basically tells you if a certain contract falls into a lease or not. First one is right to control, where lessee or the one who receives the benefit is obtains substantially all economic benefits from the use of the asset, and lessee can direct the use of the asset by basically direct how and for what purpose the asset is used during the whole of its period of use. So basically the lessee can do anything with the asset. And then there is an identified asset. Basically the asset that is leased must be stated in the contract. It may be part of a larger asset, but it cannot have any substitution rights. Thus, where similar asset cannot be used or cannot be leased instead of the original leased asset. Next up is the period of use. Period of use can be in time or in units produced. And lease may only be for a portion of the term of the contract, which means, for example, if the contract term is 10 years, then the lease term can be like for 4 years. And then the remaining 6 years could be like a service arrangement, a period with no asset use rights, or another contractual arrangement that does not meet the definition of a lease. Then, next up is the lease liability. We will talk about the initial measurement, subsequent measurement, and the payments and interest expense. For the initial measurement, it is counted by the present value of future lease payments, plus expected payments at the end of the lease. It is also discounted at the interest rate implicit in the lease or lessee's incremental borrowing rate. Maybe from hearing this, you might be like confused. What does it mean? We will do some questions shortly so you can get a better understanding on this material. And then for the subsequent measurement, the lease liability can be increased due to interest accrued on the outstanding liability, or it could be decreased due to lease payments made. And there is also interest. So for the increase, it is basically because of the interest expense, which is allocated to periods during the lease terms by applying the interest rate implicit in the lease to the amount of capital outstanding. So basically, you multiply the interest rate with the outstanding liability. Interest expense will be higher in the beginning and get smaller as the liability decreases, because again it is based on the outstanding liability. And then interest expense is presented within the interest expenses on borrowings and lease liabilities in the financing category of SOPL. For the lease payments, you're not only paying the capital or the initial measurement, but also the interest payments. Then, how do you present or how do you record this? You can record lease liabilities. You must record lease liabilities as non-current liabilities and current liabilities. It is disclosed separately from other liabilities, either in the SOFP or in the notes. For the interest expense, as I've said before, it will be shown in the financing category of SOPL. Here is the calculation of lease liability. We will go to questions shortly, so stay tuned. For this, for the there is two kinds of payment, which is made in arrears and payments made in advance. For payments made in arrears, we can see here that first know you need to count how much is the lease liability, the initial measurement, based on the PVFLP. And then you can find the interest expense by multiplying the PVFLP with the interest rate. There you find the interest expense. And then for the installment in arrears, you can find it in the question 2. And then by adding the interest expense and subtracting the installment, you will find the liability at the end of the period. Then to determine how much is the current and non-current, for the current one, you will count it based on the interest expense at at the next period. So for example, if the period now is 20x1, then you must count the interest expense for 20x2, and you must subtract the interest expense with the installment in arrears for that year. For example, if the interest expense is 200 and the installment in arrears is 2000, then the liability is 1800. You basically subtract installment in arrears with interest expense. That is your current liability. For the non-current liability, it is basically the outstanding amount, and then you add it with the interest expense and subtract it with installments. There you find the non-current liability. For the payments made in advance, firstly, still the same. You find the initial measurement first based on the PVFLP, and then you will count the interest expense, nothing different. But the difference is here. You count the ending balance by adding the interest expense to the lease liability. That is your ending balance. And for your current liability, you can find it based on the installment in advance. So you don't need to subtract it with the interest expense. And then the non-current liability will be the difference between the outstanding liability and the current liability, which is the installment. So for example, if the outstanding amount is 200 and the installment is 20, then the non-current liability is 180. Next up is right of use asset. This is the presentation criteria for right of use asset. Basically, right of use asset must be presented separately from other non-current assets as a separate line on the SOFP or within the notes. Basically the same as the lease liability, and if qualifies as investment property, then it would be presented within investment property. Now we will discuss one by one the two options. The first one is separate line item on the SOFP. Basically, your SOFP will be looking like this. There will be PPE, and then there is right of use assets. However, if you choose to include it in one asset category and give the right of use asset in the disclosure, then you can do it like this. For the SOFP, you just put it as PPE 620. However, in the note you will show the breakdown, which is the own PP is 500,000 and right of use asset 120,000. For the depreciation of the right of use asset, it will be shown as depreciation expense in the operating category in SOPL, and it is usually aggregated with other depreciation, so no need to be separated. And for the accumulated depreciation, it's also as the same. So basically, it subtracts the value of the asset. It will be shown in the non-current asset in SOFP. And now the measurement. The key point of right of use asset is basically the right to control the use of the asset. You can only recognize it when there is the right to control of the asset. The initial measurement is at cost, basically the initial measurement of lease liability, the PVFLP, and then payments made before or at commencement of lease, which is not included in the PVFLP, and then less incentives received. You must also add initial direct cost and PV of cost of dismantling, removing, and restoring the site. What is the initial direct cost? It's basically the cost that is needed to make sure that your asset is ready to use. For example, the cost to bring the asset from the factory to your factory, from the supplier to your factory, and that is your right of use asset value. For the subsequent measurement, there is three options, which is the IS16 cost model, revaluation model, or investment property. For IS16 cost model, the right of use asset must be depreciated over the useful life of the asset if ownership transfer at the end of the lease, or if there is no transfer of ownership, then it will be the shorter of the lease term and the useful life of the asset. For example, if the useful life is 10 years but the lease term is only 5 years, then it would be depreciated over 5 years. Same goes if like the lease term is like 10 years but the useful life is only 5 years, then it will be depreciated for 5 years. Useful life, as a reminder, if you forgot or anything, useful life is the expected period for which the entity expects to generate benefits from that asset. So it is different from the economic life of the asset. And then the depreciation rate should be consistent with other non-current assets in the same class to ensure consistency in the financial report. And then next up is the revaluation model. It only applies if a lessee applies revaluation model to the same class of property, plant, and equipment. And for investment property, this only applies for right of use asset that is qualified as investment property, which is measured at fair value, the market price, basically the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Next is the recognition assumption. Not all lease must be recorded. There is some assumptions to lease, which is like short-term leases and low underlying low value assets. For short-term leases, it is basically for the lease term 12 months or less. Companies can opt to not record the transaction as lease but as expense. The election is made by class of underlying asset. So for example, if there is 10 vehicles with short-term lease, you must choose to either exempt or include it in the lease for all of it. So like you cannot separate it based on the contract. However, for the low underlying value or low value assets such as tablet, personal computers, small office furniture, and telephones, the election can be made lease by lease basis. So you can choose whether to use the exemption for each asset stated on the contract. For example, if like there's two different contracts but like with the same class of asset, for example, computer 1 and 2, you can choose whether to exempt computer 1 but include computer 2. However, there are some conditions to this low underlying value, which is the lessee can benefit from using the underlying asset, and the underlying asset is not highly dependent on or highly interrelated with other asset. For the accounting treatment, it must be treated as an expense in the operating category of the statement of profit or loss on a straight line basis over the lease term. So, for example, the asset is $10,000 and is used for 5 years, then the expense will be 500 for each year. And then lastly is the sale and leaseback transactions. Sale of an asset and it is basically you sell an asset and you lease back that exact same asset. It is only applicable if the transaction is indeed a sale per IFRS 1. The carrying amount of this sale and leaseback is counted right of use asset is counted by present value of future lease payments divided by fair value. It Now for the sale part, we can only recognize the amount of any gain or loss on the sale that relates to the rights transferred to the buyer or lessor. And the gain or loss is presented in the operating category of the SOPL in a separate line item. Then how do you count it? First of all, you must calculate the total gain, basically the fair value of or proceeds minus carrying amount, and then you find the gain relating to the rights retained, basically total gain times present value of future lease payments divided by fair value. And for the gain on rights transferred, you can just subtract the total gain with the gain on rights retained. This is the disclosure criteria for based on the IFRS 16, where for leases you must disclose interest expense on these liabilities, depreciation on right of use assets, expenses relating to short-term and low-value leases, and carrying amount of right of use assets. Next, we will discuss some questions, but we will continue in part 2. Thank you.